This episode of Startup Project is brought to you by Bear.tax. Bear.tax compiles all your crypto transactions and makes it easy for you to file your taxes. Check out Bear.tax, that is BEAR.tax, Bear.tax. Hey Ali, thanks for being on the show.
Here.
With Stonks, you're doing so many things, and you're at the intersection of, a lot of interesting things around, democratization of investing, providing investing access to more people, sort of helping founders do more things. But I first wanted to ask you about, your career before Stonks and what you've done. And we don't have to go into deep, but, just a quick introduction of what you've been up to before Stonks.
Yeah, sure. I have been doing startups as long as I can remember. My first startup was making stickers in school in first grade, cutting them out and selling them to kids at lunchtime. Since then, they've grown a little bit bigger. I've had two venture-funded exits, Peanut Labs and Streamlabs. Peanut Labs got acquired by Dynata. Streamlabs built live streaming tools for streamers on Twitch, YouTube Live. That was acquired by Logitech a couple of years ago. And then outside of that, I also do a lot of angel investing. Probably, I want to say like close to 100 deals, mostly direct, but sometimes LPing into funds as well.
So what led to starting Stonks? And by the way, Stonks is a great name. I think I don't know how much marketing value that name alone has.
Yeah, it was funny. I picked it up when the whole Wall Street bets crisis was happening with GameStop, and just before that. And we like to keep things memorable and fun and a little light. So you'll see a lot of memes, a lot of shit posting, and we try not to take ourselves too seriously, because look, these investments will take 7 to 10 years, and really you don't really know which of them are going to work, right? So don't take it super seriously. How did we get into this? So I think it's Streamlabs, is in the live streaming space, right? We're building live streaming tools, and part of those were transactional tools, getting people to spend money, tip content creators, support them, donate to them, etc. So we paid out 750 million, actually, to content creators in 5 years, right? And one of the questions for me was always could this be applied to any other verticals? Could this live streaming approach, these tools, these things we've learned that ultimately solve the trust problem, be applied to other verticals where trust is a big issue, right? So shopping and e-commerce is one space. Investing is an even bigger problem. Startup investing in particular is, I was an angel investor, so I just cared more about this market. And it's a big trust problem because, it's based on warm introductions. It's pretty closed groups of small circles and communities. It's really difficult for people outside these circles to kind of break in and get great people to look at their deals, to even have a seat at the table. And it shouldn't be that way. Some of my favorite deals are deals I found out of network, and people who really should be getting more of a look by insiders. And so we've put those two things together, and that's Stonks. And the way we do that in a really simple way is the format of a demo day, which investors understand already. A demo day is an event, a regular event organized by an accelerator, incubator, or a fund where they're showcasing their companies in a cohort, and investors can join the rounds, co-invest. The most famous one is obviously Y Combinator, which started this whole thing more than a decade ago. But since then, now demo days have become a staple. There's over 1,000 accelerators in the US alone, and most of them, if not all of them, do demo days. So Stonks has built a platform for those demo days. We do our own event once a month as well, but now we work with Techstars, 500 Global, Draper, SOSV, Launch House, Zoogler, lots of great partners. Like many of the names, like in the top 10 or top 20, you would recognize, do events today on Stonks. Yesterday, we had 4 demo days on Stonks. One day, 4 demo days. There's Techstars 500, Nest, which is an emerging markets incubator, and Draper.
What do you see the value prop? I mean, the value prop for founders is pretty clear because you get to, the audience of, mainstream investors who are actively investing at one shot within, spending 10 minutes, right? That's the value prop of founders. What is the value prop for the investors who are joining in?
It's the flip side of the same coin, right? It's an efficient way to spend a little bit of time with a lot of companies that have been curated and vetted by someone who's put in some work organizing these deals, right? So like for Stonks, just for our one event a month, we get about 500 applications and we feature 6 companies, right? So it's like a 1% selection rate. There's a lot of like selection that goes into that. And so that's work, right? And investors get to benefit from that. Whether you attend a Techstars event or 500 or Draper event or Zoogler event, you benefit from that.
I think the outside breaking in part that you raised is interesting because what happens when an outsider company comes usually is there's no traction at all. And then there's one investor who's like the mainstream investor who says yes, and then it suddenly becomes a hot round, right? I think what Stonks does is essentially like converts, outsider company deal into a hot deal. This is what I've noticed, as using Stonks is like suddenly an no-name company suddenly gets traction in terms of like from investor interest. I don't know if that was your idea of solving it, but this is something I've observed using Stonks is suddenly there's a company which no one knew, no one knows the founder, there's no, background or, the traditional signals that we look at, and there's no name investor in pre-seed or anything, but and this is also like an international scale, right? A lot of Stonk companies are not just based out of US, but they're based everywhere. So that has been my observation. I'm not sure if that is sort of the goal for Stonks for you guys.
Yeah, that is sort of the end result of the process, right? That's again, and it's not always guaranteed to happen, but it tends to happen as a result of what we do, which is, a good way to think about it is this is the fastest way to get enough investors to fill up couple million dollars with a 5-minute pitch on the planet. There is no faster way to do this, right? So, and investors are often driven by like the round allocation is running out, who else is in the round, who are the other, who's the lead, who else is putting in money. Okay, I want to be the last check-in because then the round is de-risked, et cetera, right? So a lot of those dynamics you solve by doing this, by putting a lot of investors, a few hundred of them in a room. And as a founder, when you pitch to them, and this is true of like any demo day, you're basically having 500 first meetings at once, right? And typically, let's say there's 20 people out of those 500 that really are interested in what you're doing. So there's suddenly you've cleared that hurdle, and now you have 20-second meetings coming up on your Calendly. And guess what? Maybe 10 of them have even put in a check already. So you can also live commit. So typically smaller investors like $1,000 to $25,000 angels, right, can actually commit and sign documents on Stonks live as well without needing a meeting. And typically the larger funds, 100K to like a couple million will take a second or third meeting before saying yes. So both those tracks are open, and what it does is it creates momentum, right? Momentum in a round, as you know, is everything. If you don't have momentum, you're dead. And that's why the smart companies and the folks who really fundraise really, really well, do a lot of prep work going into a fundraise, and then they do a timed fundraise for like a week or 2 weeks, no longer than 2 weeks. It's got to be do or die, sink or swim in 2 weeks. You never want to leave a round open for months and months, because that just is like lack of momentum, right? It's the air escaping from a balloon. Your balloon's not going to fly, it's going back down. So what Stonks does is it pumps an enormous amount of air into that balloon in 5 minutes.
That's a great way of putting it. Talk to me a little bit about what happens post, a Stonks Day demo for a startup, right? Because you see obviously those commits live. How much of that converts? Is it 100% conversion rate behind the scenes? Because I haven't particularly actually invested in through Stonks. But I'm curious because there's a lot of overcommitment for most teams almost. And what do you see behind the scenes, if you can share?
Yeah, of course. So everything that you see on Stonks is real, right? Whether it's they fall into two buckets. One is like a commitment, like here's a hard commitment. I'm going to sign documents. I'm like ready to go. Those are typically smaller checks, 1 to 25,000, sometimes 50,000, but 1 to 25 is that typical range, right? And the other bucket is I am a large check writer, typically in institution or a syndicate, and anywhere from 6 figures to low 7 figures, and I would like a second meeting or third meeting before I can decide. Those are the two buckets, and so everything that comes up on Stonks results in like a meeting or like a serious intent to invest, right? Having said that, of course, not everything is going to convert, right? We know from fundraising, even the warmest of introductions like don't always convert, right? So intros, I think obviously convert less than hard commits, right? There is some drop off in both. I think with the hard commits, most of them go through. The majority of them like go through, close, and wire. Intros, I think something like 10% will actually go through, but when they go through, it's like $1 million check. So for founders, it's still like very, very worthwhile to take those meetings.
It's also because like you're also tapping into like the non-YC market, because like YC has a schedule, and most of the accelerators have a schedule that and it fits into a quarterly or a 6-month cycle, and a startup might not fit into that cycle per se. So I think Stonks.com will sort of is instantaneous, right? If you get picked and you're fundraising, like you just go there and you don't have to spend 3 months. And now that everything is remote, I don't know how much of the accelerator value is still there, because previously, like an Indian company coming to US and spending time here, maybe you got to learn and interact with people. I guess you're getting the Rolodex still, but I don't know. I wonder what's your view on how remote changed the accelerators, because you see a lot of accelerators now being part of Stonks, right?
Yep. I mean, that's our primary customer, right? Our primary customer is actually the accelerator, or in some cases the VC funds who are organizing these events. The investors and founders are almost sort of like they're part of the event, and that's why we have to build for them. But our primary customer is like the event organizer. They're the catalyst who hosts an event, and they bring all of the parties together. And you're right. With Stonks now, startups can go through a demo day format at their own pace and timing. They don't have to wait for like the end of the cohort, and also without giving up equity, right? So like a lot of the value, I think accelerators actually do provide a lot of value in bringing out of network folks into the network, right? There's that bridge. You meet people, you build friendships, you have your own little cohort, and you go through like this new world together, right? There's a lot of value in that. I don't think that'll go away as COVID is ending. Folks that have residential programs, in-person programs, I think are going to see a big resurgence this year. But the great thing about demo days also is like raising capital is a big part of the value prop for an accelerator, right? They're going to make you worthy to capital ready by helping you with your pitch, your business, some coaching, some mentoring, some contacts, networking, but also give you access to like hundreds of investors at the end of the process. And for that, they take equity usually, right? Or they ask to invest at very attractive terms. That YC pioneered. And so Stonks you don't give up equity to do that, right? If you're pitching at a Stonks event, the month of Feb, this month, we have 12 demo days in 1 month on the platform, right? And none of them are Stonks events. All 12 are like partner events. So there's Techstars, 500, Draper, and others. Launch House has this fun event coming up next week where VCs are going to pitch founders. Like, hey, please take my money. My money is better than that person's money. So this is going to be hilarious. We'll see what happens. It's kind of like a meet the fund type of event. So there's a lot of choice for founders. They can pick and choose, look at our calendar and say, okay, I like these 4 organizations and I will apply to go through their event. So it also creates inbound for our partners, both on the founder side and on the LP investor side.
Also, it's great for all the solo GPs and micro funds as well, right? Because you do a certain due diligence and filter out and pick one in maybe 20 or 30 companies, and you can technically operate a fund just through these open platforms, and Stonks being one of them. You can just operate maybe a small micro fund. You don't have to have any back office. Literally, you just deploy funds at Stonks and other demo days, and that could be a small fund. And theoretically, there is a possibility, or you can make a case that these are all out of the network deals. So and you always the saying is that all the returns are on the outside where you don't see. So if that is true, then you can really make a case that, hey, you should have a fund which is just investing in stonks.com or all these open platforms where your deal cost is almost close to zero, and you don't need any back office, and there's a certain level of due diligence the platforms are making, and then you can add a layer of due diligence or maybe connect with the founders, and you can almost come up with a new fund just focused on this outside the network strategy. So one of the things I also want to ask you about, because you were sort of the early movers into the live streaming kind of business, why do you think live streaming has not penetrated into e-commerce in the US or in US markets primarily?
That's a great question. Some startups are starting to do it, right? There's Pop Shop Live. There's another one that I think just raised like at a few $100 million valuation. What was the name here? Whatnot.
Yeah.
It's huge in China and Asia, as you know. I think it's starting to catch on in India. But I think, live streaming is a format that is very good at going deep. It's not good at going wide. So if you want to build deep trust with a small group of people who have high purchase intent and are ready to spend significant, it's a perfect format. It's not good at going wide because you have to spend a lot of time synchronously while the channel is live. Your schedule has to align for like that to happen, versus like a short YouTube video or TikTok video. You consume async whenever you want at your convenience. It's 30 seconds. So live streaming is good for going deep and creating high purchase intent, not good for going wide. I think it's starting to happen in shopping and e-commerce. Like Amazon has a live section on their site that is growing really well. They started by doing it in a really cringe way, which was like companies kind of like doing a live stream QVC style that was like totally cringe, unwatchable. But now they've realized, okay, that's the wrong model. You want to get influencers or personalities or people want to watch, that they trust, that this person is not just going to shill me whatever they're told to shill me. This person is going to like curate and like tell me what they actually like, and then that's what I should buy. So that model is working much better. It's live on Amazon.com. You can go and, it's grown a lot in the last sort of couple of years. I've been following just that. So we're applying that to investing, right? Stonks is Twitch meets AngelList meets Shark Tank, like some magic of those things put together. And ultimately, I really care about it. There's a couple of really interesting studies. There's one from Cambridge Associates that said, sorry about the baby in the background, which was, venture capital has outperformed the S&P if you look at it over a 30-40 year time horizon, right? If you look at it that long, it's actually been a really great asset class. And the other one was, looking at market capitalization of public companies and how many of them were technology startups. A huge chunk of the market, something like 40%, is like companies that were venture funded and once were startups. But they only received like less than 1% of the funding that went to the market, right? So like that ratio is just insane. Like, and so it really goes to show like this is a great asset class. It just needs to be made more approachable and accessible. And we talk about it because we're in in the, you know, in the circle, but the rest of the country, the rest of the world generally has no idea what this is, how to get into it. And so using video is an amazing way of making it approachable, right? Because there's people, there's personalities, you hear from them, and people are always a great way to make anything approachable, right? You put someone's face in there, it's live, you can talk to them, ask them questions, see what questions everyone else is asking them, and you learn. I have a bunch of friends, you know, a PM who works at Google, she joins all Stonks events just to learn, you know, watching other founders pitch, because someday she might want to do her own startup. So it makes the format very accessible. So what we really want to do is, you know, get this asset class to a point where it literally becomes a core portfolio allocation for every investor. You know, this shouldn't be something that you allocate 5% of your portfolio and only the top 10% of people do it. This should be something that like everyone in the world should be able to allocate like 30% of their entire portfolio, right? Like, what are the big buckets? You have public equities, you have maybe precious metals, real estate, maybe some crypto. Like, startup investing should be like real estate or public equities in your portfolio weighted, because that's good for you, you know, that as an investor, that will get you great returns. And it's very fulfilling. It's way more fulfilling than investing in equities or real estate, at least for me, right? You get to like support someone early with their story, you back them, they're so grateful and happy when the thing works, and you were like one of the early backers.
Yeah, I completely agree with the fulfillment part. Also, there are always two types of people who look at this asset class and come up with two different conclusions, right? The outsider's conclusion is it's the most riskiest asset class, and the insider's conclusion is it's actually the most, you know, the best long-term investing that you can do, right? And they don't look at it as, you know, highly risky. And like, I've had people who've done, you know, more than 200 plus angel investments on the podcast, and still continuing to invest. And obviously you also have done 100 plus. And people who do at that scale often tell me is it's actually not the riskiest in terms of if you look at all the asset classes. And what is your take on, you know, assessing risk in this asset class? And what do outsiders miss and what do insiders, you know, get?
I think there's like some basic principles that, you know, some people you can learn by trial and error, or by like reading, like following people like Paul Graham and like some of the folks who've been doing this, Mike Maples, and, you know, obviously A16Z puts out great content on this stuff, right? So I would think about it as sort of portfolio allocation, right? And say, okay, how much am I going to invest net new in the market this year, next year, 3-5 years? And then what's my annual sort of allocate, like how much of that am I putting into startups? So break that down into like a monthly or quarterly budget, right? So if you want to put $50,000, you know, into startups over the year, like break that down, you know, let's say that's 12,500 a quarter, and then break that down into small checks, right? So diversify. Don't put all your eggs in 1 or 3 or 5 baskets if you want to be doing this long term. You know, I don't know who said this, but somebody said, you know, was it Naval or Jason Calcanis, or, you know, if you can't do 50 in angel investments, don't do any. Just because there's such a high failure rate, and you're not going to know years in, you know, what worked, what didn't, right? So so diversify, large basket, and dollar average sort of your way in, right? A lot of people who've gone through liquidity events, I was guilty of this as a little bit as well, sort of since learned my lesson, is they will just get way too excited and overinvest into everything at the beginning, right? That leads to poorer deal quality versus like being patient and more like, here's, I'm going to do 1 deal a month, or I'm going to do 1 deal a quarter, or whatever your pace is for your budget, right? That will lead, that's some discipline that will give you better deal quality versus trying like, hey, I just have some money, I'm going to do 10 deals this month, right? Or 10 deals this quarter. Platforms like AngelList and Stonks also make it really easy to do $1,000 checks, as low as 1,000, into a wide variety of deals while you're learning. It's a great way to start learning before you build up your check sizes to 5, 10, 25K or more as an angel. So that's also like sort of highly recommended. for people new and getting into it?
I think there's also a big gap of knowledge. I think partly it comes because of the accreditation routes, probably, that no one talks about it, and the data is not, and the data is only with the people who have experience. I think the data, as probably Angel has published a good amount of research in the last couple of years, but otherwise there's hardly any data, because most of the investors are just individuals who are not publishing data. It's not compiled in a way that people can look at, what deals work, what deals didn't work, what are the signals, and like what stages to enter, etc. So I feel like that's one of the gaps, and I think AngelList did a good job in the last couple of years putting out a lot more content in terms of like what it takes to find deals. And I think they proposed the strategy as well of, don't look at and just invest in all the seed deals. I think they came out with that conclusion that you can't really find or pick a good deal. You just have to invest in as many seed deals and you'll get an exit.
Which is the index approach, right? That's the access fund, which I actually have been a big proponent. I love that report. I've tweeted about it. I spoke to the guy who wrote it, and he explained me sort of the method, the data behind it. Parker, and completely agree. We are trying to do that at Stonks as well for like the demo day deal pipeline, right? So we have a no fee, no carry best of Stonks fund, which is a micro fund, and it's the easiest way to like sort of put a few $100s into like tons and tons of deals and sort of see long-term returns. But I think indexing or like very wide diversification is probably the easiest way to get a very high return and sleep easy at night.
Yeah. So you talked about, obviously angel investing is more fulfilling than other types of investing for obvious reasons. But can you share a couple of, stories that you were part of as an angel investor that, I mean, they're not necessarily big exits, but, was a fun ride?
Yeah. Let me see what were my fun stories. So these, I mean, what's top of mind? Invested in a company called Give Panel. First money in, and they're going through a seed round right now, and super interesting sort of undiscovered gem type of out of network company, which is what I really like personally, because it's more fulfilling, so it was great. We worked with the founder, sort of strategy, coaching, but also connections, and now we're helping him fundraise by sort of connecting him to a lot of folks in the Valley, or the ecosystem here. Valley is obviously very dispersed now. It's not a place, it's a state of mind, or it's a set of Twitter accounts. So that was really fulfilling. This guy was like, he lives in rural England, and great entrepreneur, but sort of first time he's doing a startup, scaling it, few million in air, like has a business, like has a real business. Nobody knows about it. They've like they've generated, over 250 million for charities, and nobody knows about him. Like, I'm just like, oh my God, if this was like a Silicon Valley company like this, everybody would be talking about it, right? So it's very fulfilling to like find and support these people, give them cash when they need it, and then help them in their journey. Hopefully, they get more fairly valued as they mature and the company grows. It's also been fun, investing in people I've worked with, right? So like some Streamlabs folks that have left and started companies. It's been fun supporting them with dollars as well. And then through Stonks, we've done a lot of out of network international deals as well. A lot of folks in not necessarily the most well connected, but they have solid businesses, and like sometimes shockingly so, like ridiculous amounts of traction. And they're just looking for better access to capital markets, more fluid access to capital markets, which fundraising shouldn't be a game based on who it should really be based on your traction, your strength as a business, your background as a founder market fit, product market fit, how much your customers love you, sort of growth rate, future prospects, that sort of stuff. Not to say that there isn't a lot of value in high quality signal from investors and who else is investing and how hot the deal is. But those are mental shortcuts, right? And you and I know, like as investors, we just don't have the time to diligence that many deals. And so we use shortcuts, mental shortcuts, to save time and energy. And like, who else is in the deal? You know, how many other people have kind of looked at it and it's passed their filter, their judgment. And so we trust that, and that becomes a mental shortcut. And we over-index on it a little too much, right? And so unlearning that a little bit is valuable at finding great deals as well.
Yeah, I mean, it evolutionary wise, it works in most cases, right? Because it helps us making fast decisions. Like this happens all the time when we look at Indian deals, and there's a big stigma that we only look at IIT or like top colleges. Like, I mean, the same bias exists in the US as well. But the reason people do that is you can, eliminate certain risks. Okay, these guys know what they're doing, at least engineering wise. Maybe the business side, they learn by doing it. So there are certain signals obviously helpful, but again, if you are actually a serious investor, you have to like move away from that, mindset and look at each deal on its face value. But another interesting thing, I found while researching for this conversation was what you did with Poor Founders. Again, a great name, but you essentially did secondary transactions into a bunch of companies that you liked, right? That's the short story of it. Talk to me a little bit about what the strategy and why those companies, etc., and what was the motivation behind doing that?
Yeah, so Poor Founders, I do a lot of my investing with my brother and my co-founder from my last two startups. We've been doing a lot of startups together, investing together. And so a couple of years ago, there was sort of, the markets, the valuation, it's hard to imagine a time when the public markets were more richly valued than the private markets, but that was the case 3 years ago. And, so we saw, and now it's almost the opposite, right? But we saw an opportunity at that time to kind of buy secondaries in like growth stage or late stage or pre-IPO companies we really liked as a path to going public, right? So like Airbnb was, we did Airbnb pre-IPO and a few others. And that's why we set up Poor Founders from an investment perspective. But also, I think this part of the market is actually highly underserved, but you have to be a little careful how you do it. Founders, particularly first-time founders, which is the majority, don't have a lot of liquidity, right? They're rich on paper, poor IRL, and all of their net worth is tied. Like they're more all in than like anything. Like they're all in and all in squared, right? Not only are they risking everything, their time, their energy, their health, their everything, sort of sacrifice for the startup, their entire net worth is in the startup as well, right? So giving them a little bit more liquidity through a secondary transaction is actually a good thing. And it de-stresses them and sets them up for like a little bit more of a marathon. The way we did it was, you don't want to take like huge chunks like of the equity, but taking like single digit percentage points is probably low enough where you're not creating adverse incentives. And, the founders still have enough skin in the game, but they get to de-stress a little bit.
Also, usually secondary transactions are a little bit complicated, right? It requires a little bit more specific knowledge than, we don't have that many avenues to do some sort of, if you know the company that you want to pick, it's usually harder to get into a secondary transaction. There are obviously right of first refusal rights and all those complications that come into the picture. Were you guys able to get to all companies that you wanted? Or, because of there's so many complications and moving parts when it comes to secondary transactions, even platforms which are quote unquote, enabling these transactions are often fail because I remember looking at a Robinhood secondary deal 4 or 5 years back, and every time it comes up onto the platform, it fails because Robinhood declines because they have the first right of refusal, right? Talk to me about the complications that you had to face, or was it all smooth sailing?
No, it's very, very complicated, very annoying, tons of paperwork. Thankfully, my brother Murthy did most of it, but some of the approach, Forge Global is sort of a great broker and a platform. They're about to go public, I think, through a SPAC. So I got to go read their documents. Might be a good business to buy, but they've done this better than anyone else in the space, I think. But there's others. There's like Equity B, Equity Zen, or whatever. Shares Post. There's Carda with Carda X, and AngelList has a new secondaries product coming out called Transfers at transfers.angellist.com. So this is a bunch of activity starting to happen, but Forge has been in my view sort of the most interesting and sort of easiest to work with, and actually has most of what you want. Each company is different. There's we did not get most of what we wanted, and each company sort of operates on different sort of cycles. Sometimes it's like a quarterly cycle. There's roffers. There's and sometimes you can't transfer the shares. There's restrictions on, and so sometimes you're able to buy the shares outright. Sometimes they go through like an SPV. Sometimes you're buying from like a fund and it goes through like complicated SPV. If there's restrictions on transfer, but the company is pre-IPO, in the next year or two, you can also buy like a forward contract, right? Or derivatives that's saying, okay, I'm going to pay you the money now, Mr. Seller, and you are going to transfer me the shares after post-IPO at the price we agree on today, and I'm going to pay you upfront. But then those contracts come with insurance, right? Typically, like what if the seller doesn't, like somebody breaks, or the company says you can't do, or whatever, something goes wrong. So there's some insurance you got to apply to that. So yada, yada, yada. But so yeah, it's very hard to do if you're not like a professional or you haven't done it before. Primary is much, much easier. And then secondary also, you don't have information, right? In typically in a primary, you get to talk to the founder, you get to look at the pitch deck, you get like real information. Secondary, you're like flying blind. So that's why there's a bias towards later stage where like the products and the markets are much more well defined. You can learn a lot of what you need to know just looking from the outside and saying, okay, Discord is an amazing product. I don't care, what the day-to-day numbers are. High level, we know what the, where they are, what the trajectory is looking like. And you can build your own thesis around like, okay, I love the product. We think it can go here, here, here. Based on what the company is doing, we think it's going to go here, blah, blah, blah.
I think this is a good segue to talk about, like, as individuals, you went upstream into late stage, while as VCs and late stage investors went downstream towards seed and pre-seed and changed their organizational structure as well, right? A16Z, I think, I don't know, has now more than 300 people. They beefed up their, almost, it used to be that each stage had a firm, seed, there are 10 people looking at only seed, and then Series A, Series B. But right now it looks like everyone is sector agnostic and stage agnostic, with obviously their own biases. And while I also see individuals moving upstream with specific knowledge, like you almost see AngelList syndicates going into complete upstream, bringing in a pre-IPO company, right? What do you think about what is happening there? Like these companies going downstream versus individuals and micro and solo GPs going upstream?
I think people are just looking for opportunities wherever they can find them, returns. So many AngelList syndicates have come to Stonks as a deal sourcing engine. And so, Stonks is not even 6 months old as a platform. I think we're going to hit our 6-month anniversary next week. And the platform, like Stonks.com, actually became live. But even in the last few months, I think we funded, there's been over $5 million of deals that AngelList syndicates have funded, like deals they sourced on Stonks and fund on AngelList with their syndicates. So they're just looking for opportunities, A16Z and Sequoia both changed their structures, right? To give them more flexibility, either to stay invested for forever into a company or nearly forever, or to be able to diversify and do non-VC type of things, whether it's crypto, a lot more of crypto, or secondary transactions, or the like. So I think it's good to be flexible, because sometimes, you get pricing differences and gaps in the market and arbitrage. Like, I think the public markets are like cheaply valued compared to private markets today, right? That's going to adjust. That gap is going to close very soon. But today, public markets, like Shopify is down like 60% this year. And they still have the best checkout experience on the internet. And so there's these gaps. If you're agnostic, you can move in the whole spectrum.
Yeah, I mean, if you compare any of the late checkout startups, I mean, Bolt was at 12 or 14 billion. In that case, I don't know, Shopify should be at $500 billion at some point. If you make valuations, but I mean, we're almost.
But this is before with the last board CEO or the new board CEO.
I don't know, but he's still the exec, right? Executive chairman.
He's still, yeah. No, I'm just joking. That was all of Twitter had some fun drama for a couple of days.
Yeah, what do you think about it though?
The board thing, I mean, we got some fun Twitter shit posting out of it, right? So the new guy who came in was like, "Oh, we have this new employee stock option package. We're going to give loans," and that was just amazing raw material. We put out some good shit posts around it, and people loved it. So it was good for entertainment. But look, I mean, I think it's yeah, it's actually, high stakes game.
Let me rephrase that. Like, how much of it is deliberate strategy versus how much of it is natural instinct?
Look, I don't know the guy, I don't know the company, so this is just purely speculation looking in. But it's probably a deliberate strategy, right? Just is you always want to be like, you always want to be comparing yourself to someone who's up market, sort of a competitor, right? Chomping at them, which is what they were doing. And then lo and behold, 2 days later, he quits and he's starting like his own accelerator or something, right? Which is like a very, bashing on a competitor and then just launching your own accelerator is kind of like clearly part of a strategy.
Interesting. So we're almost at the end of the conversation. I just want to ask one last question. How does Stonks, you see making revenue? Because you've seen streaming, and you've seen how streaming has monetized over time. Because early streaming was very, you didn't know what would happen, right? How would you make money was a very big question. Right now we have some idea of how that looks like. How do you see Stonks' business model? I'm sure it's early, it's only 6 months, but you're trying to figure out in your own head, I'm sure. So what are your thoughts about how does Stonks eventually start generating revenue?
We don't know. It's like the streaming space, too early. I mean, the contenders, there's some obvious like business models in the space you can learn from, right? And try out and pick and choose. One is the SPV business model, like the other, which AngelList uses, and a few others do. There's the fund management business model, the 2 and 20 model. There's this subscription model, which is Carta and sort of the software stack, layer stack, charge for access, charge for the tool, etc., etc. Then there's the crowdfunding, like take a portion of the fundraise model, which is what Republic and VFunder do. They take 3 to 7%, 3 to 8, maybe 10% in some, somewhere in that 3 to 10% range of like the fundraise itself. So there's a lot of business models in this space. I think we probably don't have to reinvent the wheel here, right? It's going to be one of them. I don't know. It's I think too early to say. Right now, we're just focused on sort of GMV and driving dollars to partners and their startups, because that's where the value is for them. So today we're moving over $10 million a month from investors to founders through the lens of a demo day or set of demo days and events. So we want to, that's over 100 million GMV today, and we want to grow that to $1 billion as quickly as possible, and then worry about business model later.
Ali, thanks for being on the show. This was a fun chat for me. I hope it was a good one for you too.
Yeah, this was great, man. Great questions. Really, clearly, You're experienced in the space and very embedded, clearly a domain expert. So great questions, appreciated it.
Yeah, I appreciate your time. Thanks.